Hello, everyone. Again, another session of Stop Losing, Start Trading with Rosalie, aka Crypto Queen. How are you doing today, Rosalie?
Hi, I'm doing good. I'm watching the market. Um, Looking a little sad today, but that's okay.
It is always sad. One day out of two in crypto, it seems these days. So it definitely something we have to get used to. Yeah, there was a huge move over the weekend. It recovered. Now it went back. Again, we'll go over the trades that we've been putting on with Rosalie. I'll start with giving a brief overview of the market and what I see, but that's kind of the thing we've been doing over the past week. It's been a week now, and we can even do a retrospective. But Rosalie has had one good trade that paid off quite a bit, two trades that are still on, and we'll see how they do. And then maybe we'll discuss a ETH trade. So we have three markets: ETH, BTC, and Colt, which is what Rosalie's been trading. So we'll try to see if ETH, since we closed a position that was successful, if we can launch a new one. So without further ado, again, as people trickle in, I'll share my screen, go over some of the market moves that we've seen over the past few days. This is kind of the lay of the land. Always looking at the market first, just to get an idea of what the what you should expect. If the market goes down and you're a holder, typically you lose on the way down. And you can be a short and make money, but there's always some risk. If you're an options trader, you don't necessarily care as much about the absolute moves, but you want to see how choppy it is, how wild the movement the price moves can be. So again, we'll start with ETH, and if you look over the last 7 days, to some extent, huge drop. It recovered back and forth. This type of choppy market is kind of good for option sellers. The goal of option selling is to capitalize on that volatility. So price moving in a straight line is less volatile. But if you have something that's sideways, it's good. But you want to see movement. You want to see choppiness. There might be some dislocation, but what you want to see is that price move. So actually, that's the market crashed. We had a class on Monday trying to pick up the pieces. Now it went back and forth, hovering over 2,800. So that's ETH. Any coin you want to look at, Rosalie, maybe that we can have a deeper look.
Yeah, let's take a look at.
XRP. Oh, that's interesting. The a lot of you listeners are eager to trade options on XRP. This is maybe the XRP I see as the institutional play of the new administration. Of course, over the past year, exploded. People forgot about it, I guess, but they said, "Oh wait, XRP may not be sued by the SEC. Maybe there's some truth to it." So that's why we see this move, especially after the election. It crashed like every other token, but it's kind of good. I'd say that the definitely there's no way to trade XRP on Ethereum, but yes, if there was, there could be interesting trades there to be had. Are you a bag holder? Are you a XRP bag holder, Rosalie?
Yes, I am. Yeah,
Okay.
I got in right before you weren't allowed to trade it anymore in Texas. So yeah, a while ago.
Okay, so this is personal for you then. But yeah, it's been actually going pretty well. I'm sure
Yeah.
over the past 3 months, definitely the best run it had. One thing I just forget, we can look at the gas as well. We brought this up, maybe we'll do this, but the gas was exploding quite a bit over the past week. Nowadays, it's actually pretty small, pretty manageable. Below 2 Gwei is pretty good in terms of trading on Panoptic. We're on mainnet, but the gas can be high. But at 5 Gwei, it's $5, maybe $7 per trade, which is not 5 cents, but it's still manageable if you're sized properly. A few spikes, but again, gas is actually pretty mild. I'll try to kind of feature our friends at Volmex Finance, which is kind of offering indices on volatility. Uh, Again, let me see. Maybe the daily makes sense. Yeah, over the past several. Oh yeah, no, Ollie is fine. Over the past several days, definitely has been seeing some activity. This is the big jump that happened when the price collapsed in 20% in a day. And if you see at the current level, it's actually on the high side of where it's been over the past for a few weeks. And this is something that you see often in volatility. It's going down and decays over time, but then you have a spike. It goes down again. You have a spike here. It seemed to be sustained, and this is why we've seen a lot of movement. Maybe it's gonna go down, but you want to capitalize on these spikes. Where this is Ethereum, huge spike. It's maintained it for a few days. So again, those that were creating trades should expect high returns. I'll try to see what the Bitcoin volatility index is as well. This one is a lot more kind of regular, and that's also because it's based off of huge markets on Deribit, huge trading activity on the IBIT. Even there's a natural way to hedge. So this is a lot more what you expect. The big spike we saw in ETH, now it's gone. We saw a similar spiking in Bitcoin in volatility, but it's actually much better behaved. So another indicator of not just the price action, as I mentioned, but the IV is that over the past few days, we're on the lower side of the Bitcoin IV as opposed to ETH, which was kind of maintaining well. I'm trying to go back down, but same thing. Now we're pretty much below everything that happened since November on Bitcoin side. So again, Bitcoin is a little bit more established, but then when you look at the IV, it's now kind of on its low end over the past few months. So maybe that's why we'll see how the trade that we put on BTC performs, but that's something that. But yeah, we're eager to look at your Bitcoin trade, Rosalie.
Yeah, I'm very
Okay,
eager.
so this is the intern account. Again, we discuss these trades. This is not legal advice. This is not trade recommendations. This is just kind of us discussing trading on Panoptic. Options aren't for everyone, so this is a disclosure. The intern does what they want, and in that case, we recommended a trade on Bitcoin, and they created it last night. It seems. Currently, this trade is down $8, and we'll dig a bit deeper, but a lot of what we've seen both on the ETH trade before and even the Cult one, these trades are monthly options. They're meant to be held for several days, if not weeks. So the day to day is not as impactful. It's mostly kind of the trend. And again, I'm trying to go over the page here. This was a call spread where we bought an out of the money call for free. It's out of the money, we don't pay for it. Out of the money call for free, we buy and we sell a closer to the money put option, a call option. This is moving liquidity, and this is negative delta, meaning that we hoped or thought that the price would go down till we reach kind of our saturation point. So maybe on your side, Rosie, when you look at this chart, what do you see, and what do you, what do you see?
Yeah, so I guess I'm very concerned about the ratio aspect of it because those numbers seem to be very big. So when you divide them by each other, it gets a little choppy. So I'm just trying to kind of understand exactly how much it is that I'm spending and earning.
Yeah. So in that case, the price hasn't moved much. So there's two lines very close together. We are kind of in a neutral zone. This was a neutral to bearish. We're kind of neutral over the past day. Doesn't impact much, which is good. One thing as well that we need to see is the premium that is earned. So we show it on Panoptic, but you see over time how much premium you're earning. We're setting an option, you earn, you get paid over time, and this is going up. And the numbers are small because the position is small, but it's earning 0.15% in half a day, so maybe 0.3% per day. If we really want to extrapolate that 0.3 per day, it's 10% per month. So that's about the expected return if it stays in range and stays like that. So we're on course. The volatility is contributing to that return. And yeah, I would say that like many of those trades, nothing to worry about, nothing to panic about. It's just a trade that is doing what it needs to do, which is earning fees. And we earn a little bit in terms of premia. We lose a little bit because the price actually went up a little bit and it was a negative delta. But overall, it's a wash. We don't have to worry too much about it. So that's good. It's a good trade in terms of it didn't go against us too much.
And I'm also noticing that one of my legs is not in range. So what does that kind of mean for
Yeah,
this
so you have
trade?
two options, and this is something we can go a bit in more detail. Let me zoom as well. You have two legs to that option: buying a call option, selling a call option. we have the information here. We have the range for the two and the size of each leg. But yes, one of them is in range, and that's this one. This is the one that you sell. You want this to be in range because you earn fees by being in range. The one that's out of range, and it doesn't have the in range here, it's the one we bought. So if you buy something or an option that's out of range, you don't pay anything for it. So it's a free option, truly. So this is also a good a trade that's well constructed well, because you buy an option for free, you use that capital to sell another option, you cap your risk, and if it does move the wrong way and the ratio explodes, you know how much you lose, and that's kind of a lot more reassuring than infinite loss. Similarly, if the price keeps going down, we know how much we gain. So these two are working together, but again, a lot of what people should be noticing is if there's liquidity out of range that's not doing anything, you should be either buying it for free or buying it and selling it somewhere else, which is relocating it in a way that is creating a spread that caps your risk, so less risk for you, but also gives you all the advantages of a naked option because you only receive funds.
Okay.
So the other one we did was a call spread on ETH. This one was a winner, I think $100-ish. The other one is the call position. You had some call. You lost some money. You think it's going to go down further. So what's your? I don't know if you've been on crypto Twitter, but what's your outlook on Colt? Is it still bearish? We may get
Yeah,
crucified.
definitely still
We get
bearish.
crucified by the Milady army, but that's fine.
Yeah, we'll see. I mean, this is also a month option, so yeah, wait a couple more weeks, and then
and this is a put option that Rosalia's purchased. She was right directionally. It started here, price went down, so she's made money, but the balancing point is that she's paying money as well on the options premium side. So you pay for that extremely bullish upside that you see here. So that cuts into your revenue to some extent. So I would still hold this. You're still well capitalized. If it does move further, then you're definitely going to be in the money and kind of make money. For now, it's almost a wash. You're almost back to zero, but still in negative zone. So again, nothing to worry about. This is a monthly option, but the price of call does move quite heavily. So I would expect this to either realize itself in a week or week and a half. And then if not, then we may kind of adjust this earlier. So that's another trade that's going well. Again, both trades, nothing to worry about. We can look at it, and in terms of management, like many of those positions, you don't have to go overboard, panic. A lot of this moves slowly, so there's nothing more you can do. So, all right. So we have some intern has some capital in the BTC pair, 43% buying power utilization, which is fine. Call is 75%, but this is a trade where Rudy said, I want to get as much money back as possible. I want to get rid of my call, get more ETH or more coins back. So we max out this a bit more. The last one is the ETH USDC, 0%. So we have no capital deployed. Now would be a good time to revisit that. So we can create a new position. The last one worked very quickly. Again, in a few days, you were right. So same thing with any of those trades. What's your sentiment on ETH? Bullish, bearish, neutral? How do you feel?
Yeah, it's definitely. I'm not sure exactly what my monthly sentiment would be at the moment. I think I would want to kind of stay within a specific range, probably nothing above 3K and maybe not much below like 2.5.
Okay. So you think it could go either way in a month, but still range bound. You don't think it's gonna go to 5K or it's not gonna go back to 1,000. Hopefully not, but yes. Exactly. So again, this is more of a neutral play, and these neutral plays are also a good trade because you don't know, you just have kind of a neutral assumption. There's a trade for that. Whereas if you do it on spot trading or futures, it's a bit harder to do delta neutral. Here, especially with the range that Rudy's given me, it's actually pretty easy. So one thing you can do, and I'll try to let's be transparent. one thing you can do is to look at the strategies tab. There's a neutral strategy that exists. Then we will clean this up because a lot of them are too complex and we don't want to have you guys kind of figure out. But the one neutral that you can do is called a short strangle or an iron condor. But the short strangle is built to be a neutral play. And what we see here is that it's setting a put option and a call option at the same strike. You can be closer to the money. Now the range is between 2200 and 3500. So it's a bit wider than what Rosalie said. If you're very convinced that the range should be 25 to 35, it's a good trade because you think it's going to be narrow. You'll be covered even if it goes out of that range. And that helps with risk management because if you're convinced it's not going to move too far, it's still going to be in range. And that would be kind of this is kind of a good strategy that is neutral. You have no directionality. You think it's going to be range bound. The two options that you're selling are in range, and that would be kind of a good trade.
Yeah, I think so. I don't expect it to move much more, and if it does, then I guess you'd have to watch the market and close
Or that's right.
immediately.
The risks are is that you have potentially a lot of loss that could happen. And if it does go, and then maybe we'll size it again. There's a sizing here. Let's say 5%, and I'll explain why I put 5%. But 5% of your portfolio now is in that trade. Maybe we'll do a round number, so maybe 0.35 ETH, which is between maybe 6%. So each trade that you put on, you have first the directionality, neutral, bullish, bearish. This is neutral. The sizing is the next step, which is how big you want it to be. And 5 to 10% is a good one. 10% would be 0.6. 5%. So yeah, maybe let's do 375, 38. So neat. And the risk to that trade is if we're wrong, and if it does go and leave your range and it goes above 3,500 or below 2,200, you are exposed and you have potentially a lot of loss that could happen. And that's a risk that is maybe the biggest one I see with this trade. You have no cover. And if the price does shoot up to 5,000, and then you can see you would lose $500, losing $500. And would you be sad about losing $500 or?
I mean, definitely anything
Yes.
counts, right? But I do think it could still at that point, if the price did move to 5,000, I would expect it to drop pretty quickly
Okay.
after that. So maybe you just kind of
So we'll do an exercise. Yeah, so the point
wait
I'm getting
for it to go back.
exactly. So what you want to be in is in a situation where you don't feel either too worried or too panicky, because here we sized it so that it's about 7% of your portfolio. You lose $550 if price magically goes to 5,000. If I were to go to the max of the account, which is I am so convinced that I put all of my egg in that one basket. Here, the size is 6 ETH. That's about $20,000. And if the price were to move to 5K, you would lose $10,000. And that's actually pretty risky because the whole account has about $10,000 worth of funds. So what I'm trying to kind of also communicate is that as an options trader, you should also size correctly. You don't want to have all your eggs in the same basket. You want to have maybe multiple positions that can offset one another. But if you want to do something that's risky in terms of no capped loss, so you can lose all of it or you can lose even more than you put in, typically the best solution is to size correctly. In that case, I would say decreasing the notional size from 20,000 to about, that one would be about 1,200. And the most you can lose is 1,200. If it does go to zero, it's actually manageable, given that your portfolio could be like 15K. So as a trade, you're
Yeah.
on the sell side, you earn fees, you get paid for that risk. The only protection you have is to size your positions that it doesn't wipe you out and you can survive for another day. And this is maybe what the intern should do. Sell a straddle around the 27.75, which is about the current price. Yeah, at the mini straddle monthly option with about 7% of your bearing power. That's good. All right.
But
So
yeah.
this is what we do. We go over the existing trades. You try to set up a new one. One thing that is going to be available and kind of someone can also see this on your own portfolio is that we'll publish the points, and this is the pips program that's had been around for a while. If you notice here, we have this new box that's going to be shown either today or tomorrow, but we can see it currently the intern has earned 54,000 pips for their activity, and this is kind of the next step, which is we've been getting the pips collected and awarded over the past few days, a few weeks actually since we've launched. Now it's going to be shown how much pips you earn, and if you click on it, you go to the leaderboard, and we can see everyone's pips balance now. So some people have again earned 54,000 for the for intern, but some people have earned million pips. I think 50,000 gives that person is about yes. Intern is in the top, almost top 100. They're 107. So over
Boo.
week doing a few trades, which is selling option, buying option. Depositors earn some fees, but if you're actively trading, you earn more as well. Puts you in the top 100-ish. We expect there's going to be maybe more, so intern will have to step up. But then that's kind of the idea. So the Pips program is live. It's going to be live, I guess, later this week, later today. We can see everyone's balances. It's going to be on the Pips leaderboard. One thing that's actually pretty cool is that we can spy on people. So we were 107 here, and let's see 106, the person that's beating us. We can see what their portfolio looks like. So I don't want to dox anyone, but Gabriel, we see they've deposited 1 ETH. They haven't sold anything. They're mostly on the depositor side. So that's kind of one interesting user as well. So again, if you want to be on the leaderboard, we can show you, but you can see what other people above or below you are doing, and you can compare yourself. So that person is just PLPing, providing liquidity, that is passive, 1 ETH. This one has earned, again, 0.1%. I don't know how long, but yeah, it could be getting towards that kind of 15-20% per year. So very, very cool. Okay, so that's it. So typically we do this for the first half of the show on Wednesdays. We have options hour, which is coming later, where we can look at questions that people have asked, and this is something we'll do now. So I'll stop sharing this screen, and we can go over some of the questions. I'm gonna bring Steve again, Steve for a little bit, which is on the engineering team, but overall, thanks, Rosalie. You're making the intern some money, so that he should give you a cut of that profit. But for now, we'll see how it goes. All right. So this is Steve, also from the engineering team. He has been working on the PIP. So maybe can you add a few more comments on the PIPs program and maybe ways, and this is one question here, ways that people can earn the most PIPs, which is one of those questions that has been asked in the chat.
Yeah, absolutely. I mean, so we published that PDF with a description of how the pips are awarded. We have this interesting functionality with the multipliers, where people who either were a Uniswap LP in the past or got a POAP from a Panoptic event actually see a multiplier on their pips, a multiplier that decays. So as they earn pips, right, at the start, you'll be getting like 10x or 16x the amount of pips that you would get for the same activity, up to a limit, right? You can maybe scoop as much as like 100K or more in additional pips, which is pretty exciting. So that would be the first thing I'd say. If you're trying to maximize your pips, like make sure you're using accounts that qualify for those multipliers. And we publicized at like rewards.panoptic.xyz. I don't know if there's a way to send that.
Yeah, so maybe which type of accounts would now get a boost or an extra allocation of pips if they were to trade on Panoptic?
Yeah, I believe it's Uniswap V2 LPs, Uniswap V3 LPs, anyone with a Panoptic POAP, and anyone who participated in one of our betas.
Okay, so yeah, so we framed this so that most people were Uni V2 LPs maybe back in the day. If you're an OG, Uni V3 might be something you try. If you do it once in your wallet, we scrape the whole blockchain to look at every wallet. So if you've done it once, you get a extra pips allocation, and that should be kind of a way for you to revisit maybe the idea of LPing and being under the short side of volatility. And the way is you earn 5x the points for any activity that you do. So you would get an extra allocation, and then if you're a Uniswap LP and then Uniswap V2, V3, and maybe a beta tester, these points add up, so you can get up to 10, 15x. So that's also where it can be very, very juicy to go on Panoptic, look at your multiplier, and then start earning a lot more points just by being a kind of a user.
Yep. Yeah, exactly. So I've been enjoying that, certainly, and I've been telling all my friends to start using, even if they can't see the pips yet, to take advantage of those boosts. So that's been exciting. In terms of specific actions to take, the way we structured it definitely rewards selling really highly. So you do get pips for PLPing, putting your funds in the platform, but taking the effort to actually find a good place to sell, right, and get a great spread multiplier, so you're getting more than just even the base Uniswap fees. You're also going to get kind of the most effective pips reward, in my opinion, for your effort. So that'd be kind of the other thing I recommend, is focus on being on the sell side, and especially in range.
Exactly. So and then also we won't go too deep, but there's some subtleties. But yes, the sellers are those that are at risk the most. They can lose a lot, and what we've seen even with Rosalie's trade, if you're wrong, you can actually be buying the depreciating asset and more of it as it goes down. So it's a tough business to be in. If you're a Uniswap LP, that was pretty difficult. We make it a bit easier to risk manage on Panoptic, but still risky. But the counterbalance that we award you more pips to compensate for that risk that you take on. At the same time, if you're a passive liquidity provider, you earn less per unit of capital if you want, but you still earn because you provide a service to the users. And also, if you're a trader where you buy options, we also allocate some pips to you, and you earn half as much as selling, but it's still pretty good in terms of distribution. So you could imagine as reducing the premium you pay. So it's like the liquidity mining that happened during the DeFi summer was subsidizing the IV and awarding people more capital, and for the same activity, which is selling an option. So here we do the same thing. If you buy an option, the amount may be more than Uniswap, but because you earn pips, it's reducing kind of your total cost.
Yeah, which actually relates to a question I was kind of wondering about. If you had a directional bias right now to ETH bouncing back, because I would say I do, would you be interested in selling puts and kind of trying to actively manage that and sell at higher and higher prices, or would you try to be on the buy side? I guess when would it make sense to be on the buy side?
And yeah, and this is one question we get quite a bit, which is, what do you do if you have a strong opinion? And following a price move typically is the best time to capitalize on the recent move. And if you think it's going to go up, again, personally, I would always sell options first before buying. And that would be selling put options. And put options are positive delta. And that'd be worth to compare. I'll share my screen again. But the way that I've been successful in Uniswap V3 LPing, and I'm successful now in Panoptic, is to be on the sell side. And as a trader, when you have an option that is, you sell an option, can still be positive delta, but you have a bullish assumption. The different ways to do this is buy a call, sell a put. Long perp or put spreads are kind of iterations on that. But if you sell a put option, and then we can make it a bit more apparent, you still have some upside, and you still have the ability to earn more as the price goes up. You get paid for that, so you have a streamer that comes into the balance. And the flip side is that you maybe cap your max gain. And that's a lot of what people maybe are worried about, because you miss out on a lot of price moves. But if you factor in the fees you collect and how it offsets your risk, if you were to buy the asset, the price goes down 1%, you lose 1%. If you sell a put instead, it goes down 1%. You may be losing 0.5%, depending on where you are. And it also adds funds, so you can also offset your break-even point. So you expect to be profitable even if the price goes down like 5-10%. So buying options is a lot of what people are used to. But again, the goal is to reshape how people are trading. One, and maybe I'll showcase this as well. Why sell put and not just buy call? So this is kind of the dichotomy. Two traders mentality, which is buying calls, selling puts. And the buying the call, we try to show it very easily on the interface. You just know how much you make, what's your return, and the limited upside is what people are sometimes worried about. If you go to buying a call option, You can also have some pretty juicy upside, and you also make money as the price goes up, and you make more of it the more it goes up. And that is three advantages. You have a strong directional bias, you make more money, like this convexity, you make more money the more it goes up, and you have low risk on the downside. And these three advantages may seem attractive first. So Charles here may say, yes, I want to buy calls because no liquidation risk, upside that is unlimited. Why not? And there's always a trade-off, and the trade-off I would say for that specific trade is that you will be paying, and you will be paying every block, and you may end up paying a bit more than you think if you're wrong directionally. And unless the price does shoot up above, say, 4,000, the fees will accumulate. So it's a trade-off. Actually, and this type of question, selling put, buying calls, it's not just me talking my way through it, but it's something we can test, and we'll do back tests as well, where you can set up two bullish strategies, similar initial sizing. Do you sell a put, buy a call, and look at the results? And back testing will tell you a lot about whether it's worthwhile or not. In traditional finance and in kind of the equities world, selling options is net EV. There's a lot of risk, but in terms of net EV over many years, you're always ahead a little bit more than buying options. I would expect that the same thing could happen on Panoptic and on-chain options, but it's all a matter of maybe back testing. But yes, I would say that the world we live in from the equity side tells you selling puts is definitely the more advantageous position to be in.
Could the delta or the Vigoid ever sway you? Like if you saw extreme values, would you rather be on the buy side?
Exactly. So and then this is also me doing the spiel. You may have heard me say it on Twitter, but the Uniswap market now is underpricing volatility. So if you set an option on Panoptic or provide equity in Uniswap, you earn a fee, but that fee is actually lower than what the market would be willing to pay for it. And that's because there's no way to buy or short an LP position. You can only do it on Panoptic. And currently, you can take this into account. This is where the back test comes in. But there should be a point where it's cheaper to buy options because there's like a lot of selling activity that happens. So you could even be net positive EV in terms of the fees you pay, because you underprice the fees because the implied volatility is low. So I would say that, I don't know if people see, but yeah, the best way to first enter into positions, say you want to buy 1 ETH worth of calls, and buying is totally fine as well. Again, I'm actually going to wait for the back test to tell me a definite answer if the crypto variant works or not. But when you buy an option, you should go to strikes which have a lot of liquidity. So I'm going to show here. What we see here is options being sold. You have some solid green bars, some that are kind of emptied. So that one strike in particular, for instance, you have a lot of options being sold, but a lot of it have been purchased. So in the end, there's only a tiny amount of liquidity left in that strike. And if you look at one that's a few strikes over, there's a lot of liquidity left. So that one that has a tiny bit of green here will be more expensive per block than this one here, which has a ton of liquidity. And here the Vigord is 1.05. You just pay 5% more. And if we were to go to maybe this one, you pay 50% more. So Vigord is a more advanced topic, but it's also something that you have to kind of take into consideration when entering a trade, when you sell, also when you buy. So if you are extremely convinced that you want to buy an option, the first step is to also look at where's the liquidity. In that case, the $3,050 strike seems good. It can sustain up to maybe even 3 ETHs and still pay, again, 25%, but it's still manageable in terms of cost. And that could be also a good trade. So both of them are good. Personally, I go on the sell side. Maybe, what about you, Steve? Again, you're learning this as well, but would you be on the sell side or the buy side if you were to go bullish?
I've pretty consistently been on the sell side, kind of for similar reasons as you're describing. Like the traditional finance history is that, like, you know, the premia is worth it in general. I think that especially in crypto, right? If you look at the range, if you grab that tag and show everyone the range of the option, like the upper range is 3,800, and I feel pretty confident in my ability to like move my position as need be. And if you do that as a seller, you're still capturing basically all the upside the buy side gets. So it just takes a little bit of attention and management. And with tools like, I use those like email alerts for prices, right? And so if I get an email alert and I'm like, oh, the price went over 3,400, I just log into Panoptic and I spend a little gas to move my position. And I guess that's the big key, is that like this does scale with gas cost considerations too, right? Like if you're trading like $100 account,
Yeah.
and you want that long tail upside, then maybe it makes sense to be on the buy side.
Exactly. And again, the gas, we're going on mainnet for the liquidity, but we'll go on all the layer twos. A lot of folks are asking about layer twos, and even now in the chat. So at the end of the day, we'll get you covered. The gas is a rounding error if you're a big fund, but it could be a huge expense if you're a smaller side, even if you have 10K worth of capital. You don't want to pay $50 every trade. So definitely something that's on the radar. And the you can think of this as the beta on mainnet for the whales and the risk-taking individuals to trade. And then by the time it's all figured out, it's going to be a very seamless experience on layer twos.
Yeah. I guess my other question, when you were showing the select strategy modal, you pointed out that like long perp is another way to kind of go long.
Yes.
When would you do a long perp over necessarily selling a put or buying a call?
Yeah. So long perp is perp trading. A lot of folks are used to this. It's also two options trade kind of glued together that create this perp profile. So again, it's 1-to-1 going up with the price. It's a 1x perp. And because we do this in a way that's capital efficient, again, it's 5x leverage by design, meaning that you deposit some capital and you have this capital backstop if you want this. So if the 5x leverage, if the price goes down 20%, you may lose your funds. But it's another trade that a lot of folks may be used to in terms of perp trading, directional trading. In that case, it's also a good trade to have if you want to hedge your deltas, for instance, and not have to go on a different exchange. The thing that's very important is the funding rate of that position. In perps like Hyperliquid or GMX back in the day, you have a funding rate that's defined by the whole market, short versus long. How much do you pay? How much do you get paid by going short per block or per funding rate period? And that's the only maybe concern you have as a perp trader. You're used to the risk. You think it's going to go up, so you do it. But it's the funding rate could be adding up, but it's not that big of a deal. Here we have a similar funding rate on Panoptic, and you're buying a call and selling a put option, and these two are exactly on top of one another. And if you were to do that trade, you buy on one side and you get paid on the other side. They should net out against one another. But because you pay more as a buyer, there's a spread that exists, and that is also your effective funding rate. So again, there's 1.25x on the call side that you pay, and you get paid 1x on the sell side. So that trade would not be a good one, I'd say, because you are paying to get upside. But if you were to, so you're paying. So it's not necessarily the best. Let's try to fine tune it so that we have one that will pay you for going long. And this is also something that, maybe I'll change the size. You can change and kind of tune. And this is maybe up to 1.5. Yeah, there we go. So again, the payoff you see is going to be the same regardless of where you put those strikes. But the key point is how much you pay on the buy side and how much you get paid on the sell side. And here in small characters, the put side now gets paid 1.13x of on the amount that's being kind of purchased. So you earn more on the sell side, and you pay only 1.088% more on the buy side. So these two numbers actually would be very close to netting out. You could be even a bit more positive because you sell at the right place and you buy at the right place where there's a lot of liquidity. So you get paid to go long, which is quite kind of opposite from what you see in most protocols. And changing the, maybe we do this in a way that's automatized in the future, but yeah, changing the parameters may mean that now what was a trade where you get paid goes back to being one where you lose in the long run. So it's all kind of something that people that are trading perps will be very familiar with the VGOD because that defines your funding rate. So going short or long, and maybe let's try the short, but both of them could have a positive or negative funding rate depending on the type of trade that you're creating.
Yeah. I guess personally, is there a particular asset you'd be trying to short right now?
Oh no, I'm always neutral. Even if I think I'm smart and I think it's gonna go up, I'm always wrong. I'm more reactionary. So looking at the price, huge drop, and maybe I sold puts here, and it typically reverts to some extent, especially in violent moves, and maybe it's driven by a liquidation cascade. So a lot of the times you want to capitalize, and if I were to go short, it would be because there's a huge upside move that I don't think it's sustainable.
Mhm.
And then ETH is not that. I don't think BTC is that. So I would not short anything particularly. I would be still maybe a bit more neutral on the ETH side here, but still, it's not going to be something that I would be directional now. Again, large moves. You want to be in the situation where you make money when the market is quieter, and then that allows you to sustain these large losses. Maybe when there's a big move, but at the end of it, it's not going to be being neutral is always a good bet if you can size properly.
Yeah, no, that makes sense. I just saw the short perp and I had to ask.
Yes.
Cool. The other thing I wanted to talk about, the Uni V4 launch has now happened. And obviously we're both kind of on the engineering team. So I guess I was sort of curious, like now that the launch is out there, people are actually, using it. Is there anything you're particularly excited for Panoptic to integrate with?
Yeah, exactly. So the focus that we're doing now, we go in the markets page. So the good news is that we'll but to work on Uniswap v3. We had to change the code a little bit, but it was manageable, and we can make it work on Uniswap v4 as well. So what you see here are the markets where a Panoptic pool has been deployed. And ETH and BTC are the two bigger markets that we focus on. But you have Eigen, Pepe, Badger, BTC. I don't know who trades that, but all of those have been deployed. Elon USDC, you can trade options on those. And that is kind of the same process will happen with V4 as well. So you can only deploy on top of an existing pool. This is a Uni ETH, for instance, pool. You can deploy a Panoptic pool on top, but if it's a Uni V4 pool, you can also do it as well. So currently, the process to create a market is pretty straightforward. You just look at whichever one you want, SPX, wrap ETH. You can go on it, create a market. You get a cool looking NFT as well. Slightly not safe for work. And you can mine rarities. And again, if you click a few times, you get better looking ones. So the same process will happen on V4. So there might be a hook feed here in the fourth column, which is hooks. The contracts have been deployed. The UI still needs a few things to bring it up to speed, but now the focus was shipping the pips leaderboard. This is done. We'll have also the V4 integration also coming probably next week. And that's going to be as seamless. So at the end of the day, you'll come into the market, you look at the most liquid one. You may be agnostic as to whether it's a 30 bips pool on V3 or the 5 bips pool on V4, or maybe a pool with some hook logic. You just care about the liquidity at some point. So that's going to be easy to kind of get onboarded there.
Yeah, really cool. Have you seen any V4 pools that you're like, oh, I want to trade that right now?
Yeah, I don't know if hooks have been live yet, actually. Maybe we can do some investigating too. The Uniswap team has launched. If you go to the new, you create a new market, they default you to be a V4, which is kind of very cool. New V2, V3, and V4. It's V4 by default. Haven't looked too much. Again, I'm I probably would have. I stopped LPing when Uniswap came out, so I may be going through different Uniswap pools, but only through Panoptic. Again, I like earlier, but yeah, I would say that unless there's a hook one, and I don't think they allow hooks yet, a lot of liquidity is still going to the big pairs, which is kind of wrap ETH and USDC. Oops. So yeah, I would. Yeah, I don't know. I would have to look at it more closely. Can we see the V4?
No, you're right that the hooks aren't really live because hook routing isn't live in the Uniswap interface. I've been checking out a bunch of the different Uniswap hook aggregator sites like uniswaphooks.com.
Okay.
A lot of them are they all kind of make the one-line pitch of we boost LP returns, right?
Yes.
You solve permanent loss, and so some of that is exciting for us, right? Of like, oh, well, that would mean option sellers that build on top of it, if their claims are true, would earn even more. That's pretty cool. But I also think a lot of it is probably maybe covered or conflicts with how we do things, right? Like it positions the fees to be after the after swap hook or something like that, you know?
Yeah, so that's it. This is the vanilla hooks are very, very cool. Oh, there's, yeah, so that's one way to do this. If there's a hook that infers, like, affects the fees, that might be some integration happening on our side or the side of the hook builders. But overall, work with most vanilla hook. If it's fee specific, maybe it still works, but then the fees aren't. So yeah, there's a market driven. If someone tries to create a panoptic pool on top of a hook that has no fees or fees that are inaccurate, you could still trade it. You could still buy those. You could still be kind of uh, trading on that different fee, and maybe you buy more because it's cheap, and then now you just turn. So I'm actually excited to see. We are kind of agnostic, and if the fees are kind of wrong because you don't get that donate event tracked properly, maybe you can still trade those and get options. So again, that's a different way. The Someone in chat said that Flanch is live, which is, wait, is it Flanch or GG? Where is that? We can have a look as well. A lot of the yeah, exactly. What people maybe are interested in the hook space is adding ways to maybe add more functionalities or new features to Uniswap. Now it's just swapping and providing liquidity. Flanch allows you to kind of launch, maybe similar to Pom.fund, that launch new tokens and trade them. Oh my god, yeah, I'm sure we'll see a lot of high quality coins there. But maybe that's another way. I think they are integrated into Uniswap before, creating kind of some of that liquidity management or yes, distribution. This is live. It's on base as well, so it's different on layer twos, but we'll launch on base. We'll have maybe panopticals on top. But yes, Flanch trying to kind of, and it's actually a pretty sleek website. But yes, Flanch is kind of trying to get into the meme coin launching business, but now deeply integrated into V4.
Yeah, this is really cool. I like that they went ahead and did this without needing support from the official interface.
Yeah.
Like,
I mean, yeah, I don't know. I don't want to. Yeah, quick buy. I don't want to dig too much and see at the. Yeah, that's right. See the coins, but there is some level of liquidity. I think the if it's similar to Pom.fund, and instead of getting promoted to, I guess they use Radium on Solana, but to V4, it's only helps the ecosystem. It's a good way to do it. The road towards fair launch is a lot of what people are doing. Yeah, I know, but yeah, this is cool. This is something that was pretty difficult to do, I'm sure, before with V3. Now with V4, a cool hook allows all of this kind of logic to be implemented easily.
Yeah. The only other thing I'm excited about are kind of the hooks that promise to kind of incorporate off-chain data as well. There's a lot of hooks that claim that, like, oh, we'll kind of boost LP fees if like volatility is spiking off-chain or something like that. And I think that will create some pretty interesting panoptic trades as well. Then, you know, you could take a buy position knowing that some off-chain data source will affect how much premium you pay, for example, and can get pretty big brain with it.
Yeah, exactly. And then this is kind of the design space is much larger. A lot of what you do is kind of now not limited by technicality, but rather like what you can think of. So yeah, I think again, I don't know if they're live yet, but the Sorella team, they have Angstrom that's launched. That's one of them that has a higher profile, but there's Arrakis as well. There's a few others that are kind of tackling that problem that, again, and the it's a big problem. You have huge price move. Arbitrageurs have 12 seconds to react. And the way that they do is that they hedge it, they buy, or they do the trade, but they make so much money that they can actually, with the gas, with all the expenses, they can pay a lot more to the validators to get that one trade in. And what could be I don't know, $1,000 arbitrage gets reduced to maybe $100 arbitrage because $900 of that goes to validators. And if that trader or arbitrager was ready to pay $1,000, maybe they should go and pay the LPs as opposed to the validators, which validate, but then they don't have capital at risk. So that's a very, very good way to approach this. And it's kind of where you have a settlement price, you have some type of auction, you kind of take control of the executions that at the end of the day that extra $900 of arbitrage that's paid will go to the LPs. And again, and then that's kind of one way. The what I like to see as well, and it's a different trade, but on Panoptic, if you think about this, you have the same prescience. You know, okay, in the next 12 seconds, the price is going to go up by 2%. And you could also do a trade also on Panoptic, which is you think in a way, you know the price is going to go up. You can buy a lot of calls, and maybe you buy them very short dated, but you can also gain by buying call options. These call options will be in the money. You leverage on chain by buying options, and the extra fees you pay will be now on the spread multiplier, on the the Vigoid term. So you could do some of that kind of value extraction by, instead of arbitraging and paying the validator, you still arbitrage, but you dip in both ways. You are the one trading, but at the same time you create calls that become in the money, and then you earn on Panoptic. You earn with that arbitrage. You pay the call options premium to the holders of that option. So that's also another way, and that's also another way that you can imagine a lot of these liquidity strikes could be kind of like cheap, but if you buy all of it, you still have kind of a which you capitalize on that. So again, maybe MEV searchers or bot builders think about buying call options when the price is going to go up, right before it goes up. Do the trade, close these options, get paid. The whole thing will also be on chain.
Mm-hmm. And then they could also do a flash loan to put in their collateral in Panoptic and then get leverage on that.
Exactly. And again, the possibilities are endless, but also it's another way to bring that value back to options traders, LPs, those that are on chain first. And it's also kind of credibly neutral. Yeah, as long as your trade goes in, then you can make the money there.
But so for you, as someone who's really price neutral, you don't want to bet on price. If you were going to do programmatic trading, right? And let's say maybe not like intra-block trading like MEV searching, but you're going to manage a portfolio at a high level, kind of what strategy would you pursue?
On the option side?
On the option side, especially as a programmatic Panoptic user.
Yeah, so a lot of as you dig deeper, you're trying to do the job that options market maker do. Mm-hmm. And this is a complex problem. The folks at, again, Citadel, Optiver, like Millennium, all of those have supercomputers. They have FPGAs to kind of compute the whole surface. They have, again, optical fibers that go from one place to the other to maximize kind of the minimize the latency. And it's a tough problem to be in. And you can do an okay job and lose a lot of money because the big guys, those that do this professionally, again, they have the FPGAs, they have the math PhDs, and they do it very, very easily. What I like about blockchain is that it's a lot more democratic. You don't need to have special access to that optical fiber. You don't need to have kind of a team of quants and supercomputers. You slow down if you want the whole process to 12 seconds, which means anyone can participate with a decent computer, or even if it's like less than a second on layer twos. It is kind of democratizing this aspect. So you could still be quite competitive making options on the blockchain without having to kind of spend 50 million of capital just to get there. So back to the initial point, the best way, and this is what I do now, but if I were to do it professionally, is that you selling options is, again, what I do. You sell straddles and strangles. And if you do it at the retail level, which is what me and most people listening are, you want to do it in the monthly to even yearly options, maybe weekly if you kind of can be on top of it. But if you sell something in the monthly option, you just have to manage it once every few days, or even every week or week and a half. And that's kind of a good place to be in. You don't want to be on top of it 24/7. If, on the other hand, you want to be a lot more active, then you go to the dailies. Then you go to those that have a lot more capital concentration, but then you need to manage them more frequently. You can even do the hourly. So this is similar to even just-in-time liquidity that you see a single block. It's like a minute option, or less, a 12-second option. But I would do pretty much the same thing, but at tighter ranges, shorter dated options. When I trade now, I look at opportunities, who is buying, I sell there, and I kind of maximize kind of that chart to optimize how much I earn. You can do the same thing on the blockchain, on the daily or even hourly option. to capitalize. If people are buying on the hourly time scale, you can sell on the hourly time scale. There's in that case a lot of the buying as well happens on the monthly. But yeah, so that would be just trying to do the same thing, but same strategies run at tighter ranges. Just means more frequent updates, but not necessarily different kind of strategies. And that would be kind of the way I would approach this.
Yeah, that makes sense. Do you think the tighter time ranges, if you like kind of drag that tag a bit too, I think there's not as much liquidity there as there is like something on the 1 week time scale right now.
Exactly.
Yeah, is it still worth trading that though?
Yeah, I tweeted about it. So someone sold put that's deeply in the money. So maybe they have conviction that the price is going to recover, but this is out of range. This is not earning anything, and you see some of it has been purchased. So you can go on the options chain how you can do some investigating. So someone sold $67,000 worth of puts. Someone bought $10,000 of it for free, and this looks like a put spread. So at the end, you can still have activity that is daily, but people don't look at it for weeks. If you want to buy and trade 0 DTEs, then you'll have to have a class of market makers that can meet the demand. If you want to buy maybe retail level, you can trade on the weeklies, and this decent amount of liquidity, you can buy and sell options on the weekly time scale. They move a lot quicker. You earn more yield or pay more yield. The monthlies, where there's yearly even. This is extremely wide. This is the V2 like range from 1,300 to 5K. And if you're also a bit agnostic, you don't care too much about price moves day to day, month to month, but you look at 3 to 6 months intervals, then yes, you can just sell yearly options. You'll earn yield. Me as a retail trader, I can buy this option to create a spread or a calendar spread or some type of defined risk strategy. I pay you more as the option seller. You get more as a. So at the end of the day, the each layer has kind of use cases. So yes, funds, those that are earning yield and diversifying, can certainly trade the yearly options, or monthly. Retail should be weekly and monthly, but then yes, advanced users daily, even hourly options.
And so your kind of philosophy here is you're going to sell on the small time scale. You'll make great Uniswap fees doing so, and you don't mind kind of being the first one to show up to the market and hoping.
Exactly. And then you get paid if there's no buying activity, which is a huge advantage compared to a lot of markets. And also there's an ecosystem growing. If you sell, someone can buy and can actually go there. So maybe that concludes it. So we're about on the hour. This is again, this may be long. We'll try to cut some of those so that they can be repackaged. You can actually see it. But yes, at the end of the day, we realize options are quite challenging. Uniswap V3 is quite challenging, and V4 as well. We try to make it more accessible. Feel free to ask questions. Again, we had a few questions as well that we didn't have to go over. But at the end of the day, the goal is to convert users to being options traders, option sellers, risk managers, as opposed to pumpers and kind of people that want to swing trade. So options are kind of the sustainable way to earn a yield. You know where the yields come from. You know how to manage risk. You can diversify. You can generate returns. That's kind of the goal of options in a way that's a little bit more kind of even transparent than market making on again, other entities that have a market maker in the background. Here it's all decentralized and purchase. So anyways, thanks a lot. So maybe Steve, any last comment again about before pips or anything else that's on your mind?
No, I mean, I'm excited. I'm excited to see people watch their pips grow and excited for the usage that'll generate. And yeah, I mean, to your latter point, yeah, it is, we're an open platform. Anyone can show up and be that market maker. So if someone is excited about the 1 hour time scale, I'd encourage them to check out like some of our botting tools you can build on top of and participate in the market and collect a lot of streaming doing it. So I'd certainly be a buyer.
Perfect. All right. Yeah. So thanks a lot, Steve. Thanks, Rosalie. I think she's busy looking at the P&L charts. But again, we'll meet again on Friday. And yeah, this was great. So thanks a lot. This is Options Hour with Panoptic.